Let's turn our attention now to this reading on publicly traded real estate. And what you'll see is that this provides a lot of contrast to the idea of private real estate. So if you're going to go out and buy an apartment complex, well, you're a private real estate investor that carries one set of risk and return attributes. Public real estate is going to be, in many ways, quite different. So if you want to think of the taxonomy of public real estate, well, if we want publicly traded real estate stuff, then we can divide that into two categories. One, we can either be equity investors. So if we're equity investors, what we're going to talk most about in this reading is the idea of an equity REIT. So we've got a REIT is just a company, right? You think of just a regular corporation. But because of special tax implications or tax considerations, it operates to own passive real estate, or real estate passively, meaning it's not a developer, and its primary function is to generate income from owning real estate. Well, that's going to be a REIT. We'll talk about the specifics in a little while. Okay, there's also other types of equity investments, and that would be just a company that doesn't qualify as a REIT. So maybe this is a company that likes to buy land, develop big apartment complexes and sell them, or condo units, or whatever it is. So that's a real estate operating company, a REOC. So a REOC is just a company, right? They happen to, their business is real estate. Just like a chemical company, their business would be chemicals, right? So a REIT is a REIT because of special tax considerations, and with those tax considerations comes some limitation on their operating spectrum. So if they want to have the tax advantages, they have to operate in a certain way. So that would be on the equity side. On the debt side, well, there's a couple of ways to access this. There are REITs that invest in mortgages. So you could have a REIT that goes out and buys mortgages for, lots of properties. Okay, we could also do the RMBS, CMBS thing. That is, residential mortgage-backed securities or commercial mortgage-backed securities, which are discussed in a little bit in the fixed income material that you'll be reviewing as well. So are you going to go equity or are you going to go debt? Okay, well, what we're really going to focus on mostly here is this idea of equity REITs as a way to access real estate investment as part of your portfolio. So real estate investment trust, it's just a tax-advantaged company, right? So it's a trust, but you think of it a tax-advantaged company. And the tax advantage is that it is exempt from corporate income tax. Well, doesn't that sound like a lot of fun to not have to worry about corporate income tax? So essentially what this says is and there's a lot of little details around this, but if their mission, and there's some parameters they have to meet in order to define that and prove they're still adhering to it, but if their mission is to generate income from owning real estate, they can build an apartment complex and then lease it out. Okay, they more frequently will buy it after it's built, but they can build it. But what they can't do is build and sell and build and sell. If you do that, you're going to be a REOC and not a REIT, right? So a real estate investment company or investment trust is going to buy real estate and then hold it in the long run. That doesn't mean they can't ever sell it. Okay, they will have sales and they will have purchases and all those types of things, but in the main, what they do is they collect rents, right? And if they do that, the carrot is that they're exempt from federal income tax, and in order to meet that, in order to get that tax exemption, they have to pay out at least 95% of their earnings, 90 or 95%. It either went from 90 to 95 or the other way around, and they pay out this huge portion of their income as dividends. So it still gets taxed. It gets taxed at the individual REIT share owner level, but it avoids the double taxation of normal dividends, right? So normally you get taxed at the corporate level, then they pay out dividends to the company owners, and then they pay taxes again. So REIT structures allow you to avoid double taxation. So an equity REIT owns and manages income-producing real estate. Mortgage REITs, they're going to own the loan. They're going to carry the paper that has access to real estate as collateral. So REOC, real estate operating company. So this is just an ordinary company. There's no tax advantage associated with this, so it's ineligible to be a REIT. So it may be because they're going to develop, that is, they're going to build and sell, or whatever it is, they're just not eligible for the tax benefits associated with the REIT because they're fundamentally different. They're more like the chemical company than the REIT. So there are there's a lot of contrast between either a REOC or a REIT and private real estate investment. So if you're going to invest in public real estate, that is, you're going to buy REIT or maybe REOC, but we're probably going to be thinking REIT here, right, versus private real estate, well, superior liquidity, right? So and it's sort of the consummate, micro, mini, small real estate investor, and took a couple of years for me to sell one of my properties. Small town, all that sort of thing. But anyway, here, if you buy a REIT, well, this is going to be traded on an exchange somewhere with some likelihood. So you can get into it this morning and you can get out of it this afternoon, right? So in and out is going to be easy. And there are small REITs where that may be more problematic. But nonetheless, typically you have much better liquidity with a REIT. Okay, lower minimum investment. So if you're going to buy an apartment complex, it's going to be, $40 million. Well, you're going to have some number of millions of dollars to put up. So if you're going to be a private real estate investor, if you want to buy the REIT, well, if the REIT's trading for $73, then you only have to have $73 plus whatever the commissions are. In order to be a real estate mogul, you don't need millions of dollars to get access to that particular asset, and also limited liability. So I own shares in a REIT. Well, if there's some big, some big liability that comes because we put something, or the management company put something in the paint that causes people to go bald or whatever it is, and that bankrupts the company, well, I don't have any liability. I can't lose more than 100% of my investment, right? On the other hand, if you're a private real estate investor, you do the same thing. Well, you can lose your property, but they can also sue you and get access to any other assets that you would have. So you have limited liability with public real estate. So you get access to premium properties. So if you want to see, I want to be the owner of Pebble Springs Golf Course, or I want to be the owner of the Rockefeller Center, then you may be able to gain access to those landmark assets. Not quite sure why you'd want that, but nonetheless, you could get access to assets you couldn't access as a private investor. You do have professional managers behind the real estate, so you don't have to have any skill as a real estate manager. Be nice if you had a little skill as an investment analyst, but nonetheless, in terms of being able to get the toilets unstopped and all that sort of stuff, you don't have to worry about that. The normal protections of it being a publicly traded security, and this idea of diversification. If you're a real estate investor, all but the very largest real estate investors are going to be under-diversified, meaning if that's the big part of your portfolio, well, in Phoenix, you got 7 different properties in 3 different property classes, but you're still all in Phoenix, right? So whereas a REIT can be, nationwide, across asset classes, all that sort of stuff. So if as an individual or an entity that does just real estate, you are going to have problems diversifying because the chunks of asset that you buy are so big. But a REIT, you pool enough money, then you can have lots of assets in your stable, and you get some diversification across region, across property types, those types of things. So some significant advantages associated with public real estate. So REIT-specific advantages that don't apply to the REOC. Okay, it's the exemption from taxes as long as they meet the conditions. Okay, earnings predictability. So when I talk about the Gordon growth model, remember, so we said the value is equal to the cash flow at time 1 divided by R minus G. And so it's one of the most used formulas on the exam. Well, when would you use that formula? Well, my standard examples are a utility firm or a REIT, right? So, well, they just own a bunch of buildings. They're collecting rents. Their expenses are predictable. Their revenues are predictable. So you're going to have a very predictable income stream. So this is more accurate for REITs than it would be for lots of types of companies. And then a high earnings yield because they're paying out most of the income, 90 or 95 or 100% of their earnings, is going to be paid out as dividends. So the dividend yield, okay, dividend over the price you pay, is going to be really high for these particular investments. Okay, so what about the disadvantages, okay, of investing in real estate through a publicly traded security? Well, taxes versus owning directly. So if you have losses on your real estate and you're a private, well, I guess you are a private investor, then you may be able to take advantage of those losses, right? You may be able to deduct them against other income. There are some limits on that. I realize all the tax attorneys ears perked up. But it depends on what your other income is and also what country you're talking about. Whereas if you have losses in your REIT, well, you're not going to be able to take advantage of those. So lack of control. If you're talking about investment decisions, or just hey, I own the REIT that owns the Pebble Springs golf course. Well, if you show up at the clubhouse and say, I'm here, get me a car or get me a golf cart and a caddy, well, they're still going to want you to pay, right? So you may feel like an owner, but you don't control things there, right? So the cost of publicly traded, of running a publicly traded company, okay, that corporate structure is expensive in terms of legal requirements. You have to make sure you have all the shareholders meetings and all those types of things. And importantly, okay, this is going to if you look at real estate, private ownership versus public ownership, okay, well, one of the reasons you have real estate investment is because of low correlation with traditional investments, right? We're in the alternative asset section of the curriculum. So you want low correlation with traditional investments. Okay? If you take traditional or private real estate and you look at the correlation with, say, large cap equities, it's going to be low. So you're getting a diversification play there. If you look at large cap equities versus REITs, okay, well, the correlation is going to be closer. Why? Because it's all priced by the stock market. So you lose some of the diversification ability or advantages as you move from private to public real estate. So anyway, and it's also going to lead to more price volatility, and because you're going to be able to observe the price at the end of every day, really. But anyway, so what about structural conflicts? So, between management and shareholders, that's always going to be a problem. Limited potential for income growth. So you're going to have, you've got your buildings purchased, you're collecting rents. Well, your income's going to grow sort of at the rate that rents grow, and there's not much you can do about it. You may be forced to issue equity at when prices are low. So you can think of some sort of economic cycle. Well, since REITs pay out something that approaches 100% of their earnings in the form of dividends, they're not able to retain earnings. So if they can't retain earnings, they have no retained equity, then if they need more equity, they're going to have to go to the market and issue new shares. Well, if they have to do that at an inopportune time, well, that's not going to be great, right? So, and then a lack of flexibility. Okay, so, you've only got one thing you can do. The investments are in place, and you're not going to have the same flexibility you would have if you had private real estate investment. Okay, so REIT shares. So this is very similar to what we've seen elsewhere in the curriculum, but talking about what drives REITs. Well, REITs are going to be broken down into different kinds. You can have a REIT that invests primarily in shopping or retail, an office REIT, a residential REIT, a healthcare REIT, and so forth. Well, when you look at this table, the first thing you should say is, well, there's no way I'm going to memorize that, okay, which is exactly what you should respond. But what I would do is I would be able to look at these different types of REITs and then think about what's going to be the prime driver. So where is this one, the red one, going to fall, right? And if you can do that, then I think you know a lot of what you need here. So when I think about shopping and retail, well, I'm going to think that it's going to be retail sales growth, overall economic activity, that sort of thing. So that's going to be my primary driver here. What about office space? Well, we already said that office space is going to be primarily job creation. So we'll see that there. Residential, well, they give us two of them here, population growth, job creation. Healthcare, okay, well, that's going to be based on population changes and so forth. My point is, don't memorize 1, 2, 3, 4. That'll drive you crazy, and you'll probably never get it done. But being able to identify, well, what's the difference in the drivers between a healthcare REIT and an office REIT? Well, one of them is going to have a really strong influence from population changes, and the other is going to be influenced by retail sales / economic growth. So I think that would be a reasonable takeaway from this table as you get ready for the exam. All right, so REIT shares, investment characteristics of REITs are what? Well, let's see, the exemption of corporate level income tax is the defining characteristic. Also that you're going to have this really high dividend or dividend yield because they have to pay out something that approaches 100% of income in the form of dividends, right? So all of their income is going to get paid out, and you're going to and that means that you're going to have really high dividend yields, right? So low growth, it's going to look a lot like a preferred stock, actually. Anyway, so we're going to have low income volatility. Why? Because they have these leases in place, and there's a variation in the macro cycle, but that's going to be smoothed out by these contracts. And you're going to have secondary equity offerings because if they need more equity, they've got to go back to the capital markets to get it because they're not able to retain any, given that they have to pay out most of their earnings as dividends, right? What about due diligence? So if you're going to buy REIT shares in a REIT, what is it that you do in terms of being an analyst, saying, okay, what is it that I need to know in order to determine whether this is a good investment? So this is our due diligence process. Well, you want to look at remaining lease terms, okay? And do you want long leases in place or do you want short leases in place? Well, long leases at attractive lease rates might be good. Credit tenants, they're going to make the payments, all that sort of thing. But short leases, okay, give you the opportunity to raise rents in a good economy. So you've got to you got to understand whether leases are long or short, and is that good or bad for you? Okay, inflation protection. So do the leases have scheduled rent increases, or are there going to be some sort of reversion? Okay, are the payments indexed to inflation, that type of thing? So in-place rents versus market rents. Well, if in-place rents are low versus market rents, then you want short remaining leases, right? So, and I sold a property, a little apartment complex, and we had lots of tenants that were month to month because they'd been there for, a couple of years or 7 or 8 years in some cases. And the people we were selling it to, they thought they could raise rents, but they were really upset that we didn't have, long leases. And I'm like, did you think about that, buddy? Anyway, so cost to release the space. So when the tenants move out, okay, if you increase the rents, lots of tenants are going to move out. What about the releasing cost? Okay, tenant concentration in the portfolio. If you have a portfolio where you have, some particular company that leases most of your space. So if you are, or a big portion of your space, if you are an industrial storage type REIT, and 30% of your square footage is leased to Amazon. Okay, well, Amazon's a good tenant, okay, but that also gives you lots of concentration around Amazon, and their health is going to be important, so you're going to have to think about that. So the tenant's financial health, I guess that goes along with my Amazon story. And then what's happening with new supply and demand, right? So if you are, in the long run, supply is going to equal demand. We know that. Okay, but are we undersupplied at the moment, given long lead times, all that sort of stuff? So you have to assess the impact of buildings that are planned by what they call rival developers here. So you think you've got this great apartment building, it's always 100% leased because it's close to the university campus or whatever it is, and so you buy it, you pay a really high price for it, and then within 2 years you've got 6 other apartment complexes that pop up. Well, now you've got to compete for tenants and bear higher vacancy and all that type of thing. Well, that's going to have an impact. So what about balance sheet analysis? Of course, you want to know about the amount of leverage, the cost of debt, all those types of things, which would be for any investment like this, but doesn't change for REITs. And then the quality of management. Okay, well, what is senior management's performance record, the qualifications, how long have they been there, how long are they going to stay? Can you figure that out or make an estimate or some sort of guess? Those types of issues are also going to be obviously important. Okay? So REIT structures, the traditional REIT just buys and holds properties directly. So they go in and say, oh, well, here's an office building, it's for sale, let's buy it. That's great. Okay, there's this UP REIT, okay, which the UP in front of REIT stands for umbrella partnership. Okay, and here the REIT holds controlling interest in a partnership. So rather than buying the building, they buy, controlling interest in a partnership that owns the building, which gives them some tax efficiencies, that type of thing, and it happens to be the most common structure in the U.S., right? Typically, this is for they have the REIT, and the REIT owns controlling interest in this one partnership. Okay, there's also, since that's an UP-REIT, umbrella partnership REIT, well, there's nothing that down stands for here, but it's the opposite of up, so we have, down REITs as well. And here, the REIT is going to have ownership in a partnership, just like an UP-REIT, okay, but usually it's going to have a lot of partnerships, and the reason for this is basically helping defer capital gains on appreciated properties. So you have owners of properties that have lots of capital gains, contributing them to the REIT in exchange for some share of the partnership, or eventually REIT shares that they can sell, or cash. So it's basically, well, all of this is oriented around taxes, but this is specifically to address capital gains tax for owners of properties who have lots of appreciation. So, and of course, a down REIT can also own properties just at the REIT level. They don't have to have just ownership in a partnership. Okay, what about types of REITs? Okay, well, the type of REIT is defined by the type of properties they invest in, and REITs tend to specialize. That's not to say that they all do that. We could have just, you know, a REIT that invests in whatever's out there. I'm sure there's some of those, but typically they're going to go and they're going to be sort of retail shopping oriented. Well, what does a retail shopping center REIT invest in? They invest in retail and shopping properties, right? There's nothing shocking there. Office REIT, well, they're going to invest in office buildings. Industrial, they're going to have lots of warehouses, storage facilities, maybe manufacturing facilities. Okay, multifamily residential, okay, they're going to invest in apartment complexes and the like. Storage REITs, you know, mini warehouses, those types of things. Healthcare, going to be hospitals, you know, maybe nursing homes, you know, some sort of ancillary services might also fit into that. Okay, hotels, well, they're going to invest obviously in hotels, and they're going to think, you know, this is the one that's going to give, you know, lots of management is required in that particular asset class. And then also, like I said, you can have these diversified REITs that are opportunistic buyers. They wait and they say, well, when this property is struggling, or the buyers that need to get out quickly for whatever reason, they're looking for an opportunity to get into a real asset, and they can and they feel like they can manage across the sectors. So anyway, so it can be diversified at the end of all that as well. Okay, what about REIT valuation? So we have net asset value per share, NAV, PS, and then we also have book value per share. Well, book value per share, this is going to be based on accounting values, right? So we already have a, you know, we know what book value per share is. It's just going to be, you know, here's the assets, here's the liabilities, this is the equity section. Take the equity section, divide it by the number of shares outstanding. That's the book value per share, right? So the assets, of course, are going to be carried at their depreciated historical cost. So we're going to buy the asset, we're going to be depreciating it through time, often not reflective of market value, and hence, book value per share often is a poor representation of the economic value of the REIT. So book value per share, I don't think that's going to be a player in terms of REIT valuation. On the exam, you should think of it as a red herring, right? Somebody's looking at the book value per share and they're worried because it's so low, and well, okay, well, that's just because of accounting nonsense, right? So what about net asset value per share? Well, net asset value per share just says, well, let's go and find, you know, we have a list. Here's all the buildings that they own, right? It's at the corner of 5th and Main. There's an apartment complex. Here's one on Rodeo Drive. Here's something else on Michigan Avenue, whatever it is. So we know the properties. We're going to go gather some information on them, and we're going to come up with the market value of those assets. So the NAV per share is going to be the REIT assets minus liabilities. So we're going to get the market value of the REIT's assets. Okay, subtract off liabilities and divide by the number of shares outstanding, and that's obviously going to give us a better measure of valuation because, you know, they may have owned these, you know, they bought property in, you know, San Francisco in 1978 and they still own it. Well, if you're looking at book value per share, that's going to be a pretty crappy estimate of the value of that property. This will give us at least some idea of what the market value of that property should be. All right? So how do we use this in valuation? So we're going to find net asset value per share based on forecasted NOI would be another approach. So the real estate can be valued by capitalizing NOI. So just like we've talked about NOI elsewhere, NOI, recall, is sometimes called F&C, right? Better write that down because it could sound like I was saying something dirty. Anyway, so F and C. Which means free and clear. So it is just the return, the pre-tax return to an investor that holds the asset free of any liens, right? So we can go in and we can forecast NOI, perhaps based on, you know, market observations. You know, we know how many square feet, we know price per square feet generally in the area for this type of real estate, that type of thing. So what we're going to do is we're going to go in and find NOI, and then we can capitalize NOI, just like we've talked about elsewhere. So we're going to say that the value of a property today is equal to year one NOI, first year forecast NOI, divided by its cap rate. we can get this from the market, and we can estimate this. Well, that would give us a way to think about the value of the assets. So so capitalization rate, we're going to take the net operating income divided by property value. So we're going to take historical transactions, and we're going to say, okay, well, we invest in Class A office buildings. Well, we're going to find the Class A office buildings that have transacted over the last 8 months. We're going to estimate their NOI, divide it by their property value. That's going to give us a cap rate, so that's going to go up in here. And then we're going to take this and say, well, the property value is going to be our NOI divided by the cap rate, which is the same equation that I wrote up here, right? So we can also go in and find the value of the REIT by, we can do it by trying to value each individual asset, add them together, or we can just look at the net operating income and capitalize it and then divide that divide that number by the number of shares outstanding. Remember, if it's net asset value per share, we'd have to make sure and adjust for any outstanding liabilities, right? We can also approach REIT valuation from taking the financial statements and making adjustments, just like we would if we were going to take the financial statements of an operating firm, start with net income, and work to free cash flow. So this is a little different than what we've seen elsewhere, so it's something that you're going to have to pay attention to. And you know, I think the logic here is pretty straightforward, but you may want to throw some of this on your formula sheet as well. But here's what we're going to do. What we're going to see is that we could, if we were looking at an operating firm, we could use as a relative valuation standard this idea of price to cash flow from operations, right? That would be one way to approach value just for an example, right? So relative valuation. Well, here, what we're going to do is we're going to come up with two measures of operating cash flows for a REIT. The first is going to be funds from operations, FFO, and then the other is going to be adjusted FFO. So there's two measures here. So ultimately what we want to do is we want to say, well, we're going to talk about relative valuation by finding for comparable REITs their price to FFO ratio, FFO, kind of messy, and then we could also do it as price to AFFO, right? So we're going to know that for the average REIT in this category, this is equal to, 4, and this is equal to 5. Well, if we can find the FFO for our firm, then we can take it and multiply it by 4. If we take the AFFO and multiply it by 5, that would give us an estimate of value. Just like if we had price to CFO for the average firm in this industry, then we could take price to CFO and multiply it by our subject company's CFO, right? So it's just relative valuation. So the only thing we're doing here is talking about different cash flow metrics. So funds from operations. So first of all, look at the words, funds from operations. So what are we doing here? We're going to get their financial statements. We're going to start with their net income right here. So there's the earnings off the accounting statement. We're going to add back depreciation expense. We're going to add back any increase in deferred taxes, just like we would do anywhere else. But now we're going to subtract off any gains or add back any losses from the sale of the property. Why are we doing that? Well, remember, what a REIT does is it operates real estate, right? So if they've owned a property for 10 years, they get an opportunity to make an exit, and then, well, great, they decide to sell because it was an opportunistic sale, okay? But that's not part of operations, okay? That has to do with investment. So what we want to do is we want to subtract off any gains because they were included in the statement of net income. So we're going to subtract off gains and add back losses, okay? And that's going to give us our FFO. So start with net income, add back depreciation, add back any increase in deferred tax liabilities, and then subtract off gains. That's going to give us FFO. And then we could take that, if we wanted to do it per share, and divide it by the number of shares outstanding. That's going to give us our subject firm's FFO. So here's our FFO. Right? And if we know the average price to FFO for this particular type of REIT, well, price over FFO times FFO, of course, these two things cancel, and that ends up with price, right? Now, that would be one metric, FFO. There's another, and that is adjusted funds from operation. And what we're going to do is we're going to take this FFO that we just calculated, and we're going to subtract any non-cash rent adjustments. And what this means is, there's specials. You move in, you don't pay rent for the first 3 months, or you have increasing rents, and there's some provisions in GAAP that let you straight line those. They're just going to tell you, this is a non-cash rent included in revenues on the income statement was $10. So if we didn't receive the $10, we're going to subtract it off, right? So we're going to subtract off any non-cash rents that have been recognized. Okay? and we don't have to worry about where it comes from in terms of the accounting treatment, all that sort of stuff. That's going to be given to you. It's beyond the scope of this reading. Okay, but then we're going to subtract off recurring maintenance type CapEx, okay, and leasing commissions. But anyway, what does that mean? Well, when we operate real estate, there's two kinds of capital expenditures. I mean, they're all capital expenditures in the sense they go to the balance sheet. But we know that every few years we're going to have to replace the carpet in the hallways, or we're going to have to replace the HVAC every dozen years, or whatever it happens to be. Those are more maintenance type items, right? And when you have hundreds of properties in your REIT, you're going to be doing some of that every year. Okay. On the other hand, there's also times when we say, oh, well, we have this apartment complex. Let's put in a laundromat. Okay, well, that's not maintenance. That's trying to enhance the earnings from the property or the attractiveness of the property somehow, those types of things. So, but all of that gets capitalized. Well, what we're going to try to do here is back out those things that were capitalized. Okay, that is, they didn't go to the income statement. They went directly to the balance sheet, but are maintenance type issues. Okay, replacing the carpet, those types of things. And then we're going to subtract those out of this funds from operation in order to get to AFFO. So in other words, this maintenance type CapEx really is like an expense, right? So you're going to have some of that every year. If you have one apartment complex, well, every dozen years you got to put in a new HVAC. But when you have hundreds of apartment complexes, okay, you're going to be doing some of that every year. So those things that represent regularly scheduled or, maintenance type stuff that went to the balance sheet, we're going to bring that back to the income statement in order to get AFFO. And then we know on the average what the price to AFFO is for the firms that we are interested in. We're going to multiply that by our AFFO, right, which again, that's a terrible A, and that's going to leave us with price. So this is just two different ways to do relative valuation with metrics that are closely related, and you can think of them as crude approximations, and they're going to be different from one another, but you can think of them as crude approximations of CFO. All right? So anyway, so that would be one way to approach the valuation. That'd be to take the financial statements and do relative valuation. So approaches to REIT valuation. So net asset value. So value the REIT's assets to a private market buyer. Okay, we could go in and do that. We could do price to funds from operation, just like we talked about a moment ago. We could do price to adjusted funds from operation, and we could do this discounted cash flow stuff exactly like we would do it anywhere else. Calculate the free cash flows just like we would for a share of IBM or a share of Apple. Come up with some estimation horizon, calculate a terminal value, discount everything back. So nothing new here. It requires us to learn one more definition. That is the definition for FFO and AFFO, but it's still just relative valuation. So there's nothing here that's going to be a big deal. So what is it that you need to know here? Well, the advantages and disadvantages of publicly traded real estate. So where is it better than private real estate? Where is it not going to be as good as private real estate? The different types of REITs, the economic value determinants, investment characteristics, principal risks, that sort of type of thing. I think I would know something about that. But the two that I would focus on would be one, the first one here, advantages, disadvantages. That is the big picture. And then the approaches to valuation. The stuff in the middle is kind of minutia. Certainly it makes for good test questions. You ought to be familiar with it. But I think it's one of those things that you know in terms of terminology and sort of you apply it, slip it into your intuition. And I think you'll find it relatively easy to get on top of. As you look at all this stuff, though, make sure that you don't feel like you're learning something new, right? You already knew how to do relative valuation. You already knew how to do discounted cash flow. All those types of things are all over the curriculum. So all we're doing is applying them to this particular asset class, sometimes with little twists, FFO, AFFO, that type of thing. But it's not like you have to start from zero and build up a new valuation structure in your mind, because this stuff is all related back to our core in terms of discounted cash flow, relative valuation, that type of thing. Good luck with this real estate stuff.